Welcome to another episode of the Bank Free Blueprint Podcast. Today I have with me Rob Barr. Welcome, Rob.
Hey, how you doing?
Good, thanks. So you are with Good Steward Financial Services, which is really the parent company for three service providers. One is Good Steward Lending Services, another one is Good Steward Capital Management, and the third one is Good Steward Account Servicing. What I would like for you to do, if you're open to this, would be to maybe start out, before we get into the details of those three businesses, would be for you to share with us how you got into real estate initially. Maybe just share a little bit about your background, touch on your family, that type of thing. And then from there, we'll go into the business piece of it.
Sure. Okay. Yeah. So I really started, of course, my career like many people in the military. But the only reason that's relevant is I was in the Navy. I was a cryptologist in the Navy, and I was all into analyzing and understanding the world and how things work and how people work together and what other people might do and how that affects our decisions and what we're going to do. And it was kind of that analytical mind, right?
Yeah.
Not too long after, I just was into business, and right after I got out of the Navy, I was just an entrepreneur. And all my life, I really had the entrepreneurial bug.
You came from a Navy family, right? Your father was?
I came from a military family. So my father retired out of the Navy, but he was actually a Marine in Vietnam, a drill instructor, and then ended up having to be in the Navy Reserve, and then went back to active duty. It's kind of a funny story. Like he's one of those odd sailors who ended up being what's called a bosun's mate in the Navy. And, once a Marine, always a Marine. So everybody, he had every job that was related to security, policing, security details, and everybody loved him and hated him at the same time, right? Because he was always a drill instructor. Yeah, funny stuff.
Yeah. So out of the military, you went into?
I went into corporate finance. Really, I started off really with a company called Sata USA. We made video games, and I started on the bottom. I spoke some Japanese. It was a Japanese company. Many people have heard of it, and I worked my way up to ultimately later the operations manager, and or the director of operations, what we called. That was the title. And after that, I was just all about corporate consulting, and I had several different businesses, but all kind of around that corporate finance and structuring sort of realm until later I had my first child, and then decided that I wanted to kind of settle in one place. I was doing a lot of traveling, and that's when I ended up in Tucson and kind of going from corporate finance, dealing with some public offerings and public companies and everything you can think of when it comes to corporate finance, and moving into personal finance, which was good. It was good for me. It was a good move for me. That was back when A.G. Edwards was around. And what made that nice is here I'm coming from a corporate background to personal finance, and other personal finance advisors were, in their mind, they're thinking IRAs and typical stocks and bonds, but never have been on the side of the company issuing the stocks. Right. So the average, investment advisor or financial advisor really doesn't live that life. They don't know, right? They know modern portfolio theory and all that stuff that's nice to talk about when you're sitting with a potential retiree, but doesn't necessarily have the practical understanding of what the company does and how it works and how to analyze it. So for me, it was pretty cool. It was a pretty fun experience to kind of move into that side before going back to the corporate finance side.
Nice. And your wife, Jessica, you actually, you guys just had a brand new baby. You've got a very cool, rather large family. Maybe you just describe that a bit.
Yeah. So we just had our seventh child. We have 7 total. The oldest is 13, all the way down to this newborn. 5 boys and 2 girls.
Wow, that's amazing.
Yeah, it's pretty cool. It's pretty awesome, actually.
Very cool. Very cool. So you are in Tucson right now, and you do you do your services pretty much wherever needed around the country. Can you maybe just break it down a bit and go into the the three different services you have: the lending services, the capital management services, and the account servicing? And how do they all tie into what an active investor who has deals or a passive investor who has money? That's really our audience here typically, where we're talk about everybody working together to get the best project done, the most profitable, the most efficient, so that everybody comes out a winner. How do your services tie into that? Could you just walk through that process?
Sure. Yeah, I'll do my best to hit what I can. Certainly, let me know if I don't cover for the right area. I'll start with account servicing. Good steward account servicing really formed with the understanding that that lenders are usually pools of investors or partners in some form. That's usually what they are. So certainly we have some lenders that the individual has plenty of cash, but most of the time in real estate, it's some sort of a pool. And it might be a syndication to buy a big apartment, or a small group to fund a fix and flip. But generally, it's some sort of pool of people that come together. And so what account servicing does is a fund administrator and again, administers these types of pools, where it allows a lender to bring in their partners and allow us the opportunity to help service that back end. Otherwise, they bring it in and they've got to do all the accounting and all of the distributions and everything themselves. Whereas when they hire us, what account servicing does is actually kind of do that back end for them. So pull the money together, send out to escrow, do the closings, all of that. So we kind of filling that need for those types of lenders or real estate investors to manage their back end. That's what account servicing does.
So that might be, let's say that I've got 2-3 loans out, or I'm lending on 2 or 3 projects, and I really don't want to handle the payments myself. I'm an individual. I have another job, and I just don't really have the time to do all of that. And I'd rather have a third party do it. Is that one of the services you provide then?
That's right. Yeah. Sort of in that mode. Otherwise, they're doing the accounting. At the end of the year, they're issuing 1099s or K1s, depending on the type of vehicle, and all that.
Is there just a real, and I think there is, but if you can share like the rough rule of thumb of what somebody might expect to pay for those services, just because it's a percentage of the deal or a minimum of some sort?
Well, so it really depends on the type of vehicle, right? The type of vehicle kind of, it facilitates or necessitates, I should say, what types of services happen. So let's say they've got a small trust where they brought some partners in, people who've worked together before. That's a little bit more simple. So generally that's a fixed fee for a setup, and then a monthly fee to cover the overhead costs of servicing. So it could be, somewhere around $1,100 as a start, and then $15 a month, pretty standard. When it comes to administering a larger vehicle like an LLC, a fund, then that tends to start to move into a different realm, right? The services get a little bit more more comprehensive and a little more complicated, and that usually is some form of a percentage versus a minimum. And then that depends on how often it pays out, monthly or quarterly. So sounds a little complicated. It's actually not, but it's kind of, you run through the question of what the service needs are, and then we price it out, and it's pretty simple process, but it's not all cookie cutter either.
Good. Okay, so that's account servicing. With that, you also do. Is that where you do your? No, I take that back, because you've got these escrow accounts, you've got different things like that, and we'll probably get into that when we talk about the lending services. But so the other two, one is capital management and lending services. How do those tie in?
Sure. So capital management is a registered investment advisor, and while it has one part that does its own deals as what we commonly call a deal sponsor, right? The guy who goes out and looks for the deals and puts groups together and kind of works to get the deal closed out, who manages that.
Maybe something like a syndicator, or would that be similar to a syndicator? Somebody who pulls it?
It would be. That's right. That's right. So we could call it like a syndicator.
A facilitator, or yeah.
Right. Yeah,
okay.
exactly.
Mm-hmm.
So while it will act in that capacity often, also Good Steward Capital Management as an investment advisor, and it provides services to funds and a few high net worth investors and a couple of family offices.
Mm-hmm.
What it does is it acts as an investment advisor. It looks at any particular transaction, analyzes the transaction, looks at all the due diligence involved, and then looks to make sure that it meets the criteria for that particular fund or investment vehicle. So its role is more of an analytical role. It's a sort of a fiduciary role where it's looking at it. Does it meet the needs for this particular fund? Right. And that's primarily what I do with that.
And that includes the investment advisor service, right?
Right.
And so if you mentioned fund, could you just go through briefly and describe there are multiple different ways of setting up a fund, but there are a couple of like primary ways or key ways that most funds are set up. Could you just give a brief description of a couple of the main?
Sure. And at some other time, certainly we can go into more detail, but the most common, especially right now, the most common is what we call a Regulation D. That's a particular regulation through the SEC for private placements. And there's
SEC is a Securities Exchange Commission.
Right, Securities Exchange Commission. And so commonly we call it by its regulation number 506B or 506C. And both of those are private placements. And so 506B is, in short, again, there's much more detail to this, but in short, a 506B allows for a certain number of what's called non-accredited investors, and a larger number of accredited investors. So again, accredited, they have to meet certain requirements. But in a 506B, there would be no form of advertising. It would be all, friends and family, people type of thing. A 506C, similar, but it is on the realm of only accredited investors. And to be an accredited investor, that you have to go through a certain verification process, not particularly complicated, but we have to certify that the person's accredited. The advantage of the 506C, though, is the advertising side of that. They've been where they're able to advertise. Again, there's more detail to that, but that's the basics of those two.
But advertise to accredited investors only.
Right, yep. Exactly. Right. So you have to. So while you can advertise in that 506C, you can't accept the non-accredited investor. Yeah. Right. So they might see the advertisement and some way come across the website or whatever, but then you're certifying, you're looking at them and validating and verifying that they are actually accredited.
And that's part of your services that you provide when like, for instance, you work with us with our funds. We've got several, we've got the C and the B and right. Just working on the Regulation A+ right now, but you are, that's part of your services to make that determination. There's certain steps that you need to follow for that.
That's right. So as the fund administrator side, we'll actually bring in those subscription agreements and go through that verification with them and set up the accounts and get them ready for payments. But yeah, part of that is to verify that they're accredited or non-accredited. Yeah. So that was the 506B and C. And then there's a different regulation called Regulation A, which has kind of expanded in the last, really over a year, but about the last year, which commonly is called A+, Regulation A+, which is much more broad and is kind of nowadays often called a mini IPO. And essentially what's happening with that is you're going through a much broader and deeper qualification process, the sponsor is. And that ultimately allows for advertising and a much larger number of non-accredited investors. And just more like how you would think of a public company acting, and it's somewhere in between. And any A pluses would eventually, their plan would be to eventually be publicly traded on a stock exchange, which this would allow them to eventually do.
Yeah, and they're typically a lot more suitable to the crowdfunding structure.
Right. That's really where it started, was in the crowdfunding structure. And so many do not. So many are not in the crowdfunding websites that we see out there. But that's really where the concept started, and where the regulation was geared toward. And as you mentioned, you've got several funds. And so we administer those under the 506B, 506C, and of course, coming up here pretty quick, we'll have the Regulation A fund should be qualified and get going.
Yeah, that you mentioned that one. You said that the level of scrutiny is higher. I can tell you, we've been working on the Reg A Plus fund now for probably a little over a year and a half, right? And so the amount of effort and work and everything that comes in for that, it's a lot of work. It's very expensive. It's very time consuming to get to that point. But once one gets there, it's that bar that's it's hard for everybody to get through. So this will be a great topic for one of our next episodes. Expecting ours to maybe come through within the next week or so here. But once we have that and it's up and running, I think that'll be a great topic, because there are some really interesting details about that whole process.
Yeah, it is pretty interesting. I mean, like a lot of the analysis that we had to do from that financial advisor side, and providing the analysis, the background, performance in the past, types of things, and then also the amount of due diligence, dealing with broker dealers and all of that it takes a while. It takes a little bit of time. But it creates honestly, what it does is it creates a barrier to market that a lot of people won't try to get past. And while that may seem cumbersome in a lot of ways, it's in a sense, it's a good thing too, right? There's this barrier to market that a lot of people won't try to penetrate.
It's one of those things where before you get through it, it's like, really? All of that? And then by the time you're through it, it's like, oh, cool. There aren't very many people on this side of the fence, so that's kind of
exactly right.
So we'll see. But the other thing that I know that was part of the reason that we went down that path was, once you get to that level, have gone through that level of scrutiny, all the detail, like the track record, the history. I mean, digging back into everything, every number in the past, it also gives that level of confidence so that broker dealers are more than likely very willing and anxious to help raise the capital for it, right?
Right. And that's really its purpose, is because like any public company, there's a necessary or certain disconnect between, GE, maybe not a good example, but GE versus the GE stockholder. Right. Well, there's no real connection. And so because of that, there's a lot of scrutiny involved before it actually becomes public and is able to trade. And so similarly, you have a Regulation A fund like the one that's about to be qualified, and it has to go through scrutiny first. Yeah. With complete third parties who have no vested interest in it at all. Yeah. From not just the SEC and FINRA, but also other, a couple of other companies that I don't want to plug them necessarily, but other companies that do that background check, and they have no skin in the game. They're completely third party, and so when they do that background, the broker dealers can feel confident about what's happened, about what the numbers say and what's going on, and have that sense of comfort level in selling and presenting their the new security, basically. Right.
Cool. Okay, so let's maybe move on to the capital. The lending services. We went through account servicing, capital management. So now we're on lending services. So let's and tell me if this works. Let's start with from the perspective of, I found this deal. I have my contractors lined up. We've gone through the vetting process. We've worked with our underwriting service, contractor vetting services to make sure everybody on the team is good and solid. What's the next step? What are the services that you're able to provide to make sure that the underwriting, the final underwriting is done and done properly, and then all the way through to completion, maybe even to full wrap up if, let's say, it's a new construction or a renovation project? What can you walk us through those steps of what an active and a passive investor, because we talk about the two of them coming together, creating a good deal, a good solid deal together. What are the steps that they could see that they would be going through in order to make sure that the project is done the way it should be done?
Okay, so even within that, there's kind of two different discussions. So one of them is certainly lending services as a broker. So a borrower might come to us, have everything lined up on the borrower side, and they come to us looking for a loan. And in that capacity, we will perform the underwriting for a lender, but then turn around and ultimately provide that to a lender, just like any broker would. And sometimes that lender is an institutional lender, sometimes it's a private lender. And so we'll manage that all the way through. And I want to talk about this part first, because when that borrower comes to us, we have to provide all of the due diligence. So we're doing all of the background checks, credit, sometimes criminal background, other types of things, right? And verifying income if it's necessary, what their experience level is in managing a particular type of project. Everything you can imagine. It depends on the borrower, right? What the type of deal is. And so we have to provide that background, and then we turn around and provide that to a lender. So again, an institutional lender is going to have, as we've all probably experienced if we bought a house, is a pretty strict criteria on what they need to see. And so we've got to provide that information and a report that goes with that to that lender. Whether it's institutional or private, it's our responsibility to give that to them, to do that part for them. So that's that broker relationship that happens with a new borrower that comes in.
Can we maybe just at this point, can you just talk briefly about the differentiation between owner-occupied and non-owner-occupied? Because we, as private lenders, private investors, virtually almost all the time stay on the non-owner occupied end of the spectrum.
Right. So, so some of the nuances that I'm going to talk about are state specific. So I'm going to speak broadly, but every state could have some different definitions, so to speak. So owner occupied, of course, means just that. That's going to be the typical home that you purchase, like my home. I purchase it, I live in it, I raise my family there, all of that. So that's going to be, at least in the residential side, the sort of typical definition of what owner-occupied means. And non-owner-occupied obviously would be the opposite of that. It says that I'm purchasing this residential piece of property so that I can fix and flip it, right? Fix it up and resell it, or maybe it's new construction or whatever, but it's a residential piece of property. Again, states have some different definitions for it. But where it gets tricky is sometimes there's property that kind of falls into the non-owner occupied, even if the owner is occupying it.
You and I just had one a couple of days ago. We had one just like that.
That's right. That's right. It was the nature of that real estate was one that had very clear businesses that are associated with it, but there's a portion of it that it maybe is an apartment. Well, that's okay. They can live there, but total project as a whole, in most states are going to qualify as a non-owner occupied commercial business purpose loan. Yes, he lives there, and there's some nuances, and some people would, might take issue to what I said because of some of the details, but
Well, there's another separation that I think helps make that helps delineate that, and that would be if it's owned by the person individually versus through an LLC or an entity. Is that correct?
There can be some differences. That's right. Mm-hmm. Again, it's, there are some nuances that have to be considered each time. So mm-hmm. If you've got an LLC and you're one member of multiple members, that would be treated differently than if you're the only, in some states, if you're the only member and that LLC is simply a facade, right? Yeah. Well, the cat's a cat, right?
Yeah, right. And by the way, neither Rob nor myself are attorneys, accountants. We don't profess to be. We don't, anything that we say get double checked, the full disclaimer of get the right advice from the right experts.
Right, experts. It's funny. I usually start off public conversations by saying, yes, I'm a licensed investment advisor or representative investment advisor, but I'm probably not your investment advisor. So, if I'm not your investment advisor, nothing I say should be taken as advice.
Yeah.
Seek counsel appropriately.
Yeah.
But again, back to the question, it is interesting. There are these differences that happen where you could have a commercial piece of property that maybe somebody lives there. And of course, again, most of what we deal with is all business purpose.
Mm-hmm.
Now, on our broker side, particularly for lending services within the state of Arizona, we do owner occupied. But generally speaking, when it comes to other services for lenders, most of our lenders don't do any form of owner occupied. They only do business purpose, with some exceptions where it's combined use, right?
Yeah. And the similar thing applies from a broker position. So California is very, very strict on the broker rules, needing to go through a broker to do deals in most situations. Whereas some states, that's a lot more laxed. And
right. Yeah.
Any comments on that?
So, just that that is the reality, right? Mm-hmm. In Arizona, for example, a private person could do a loan, but it limits his ability to receive compensation,
mm-hmm.
right? Points and such. So these types of issues that come up that could be different depending on what state you're in and what the deal is. In Arizona, we almost exclusively will go through a broker because mm-hmm. people want to get some sort of points as a lender, right?
Yeah.
The owner-occupied rule is different in California too in many ways. So most brokers will say that if you occupy the property, but the purpose of the loan is business, right? In other words, you're going to use that money for a business purpose, mm-hmm. then it will usually qualify as a business purpose loan.
Yeah.
Right. So these types of things can be right. nuances that would work in Arizona, for example.
Yeah. So a question that I get asked relatively often is the difference between real estate broker and let's call it a hard money broker or a private money broker. Can you break that down?
So there are nuances to that again are state-based, but or cultural-based. Maybe that's a better way to say it. So a hard money lender usually is looked at as an individual, not licensed within a particular state, not MLS license and so forth, and often gets the sort of the rap of saying, hey, they're the last guy to go to. They're the ones going to be the most expensive, but probably the most lenient to give you the loan.
Mm-hmm.
A broker may specialize in hard money, whatever that is defined as, may specialize in that, but by themselves is not necessarily a lender. They are a broker. And mm-hmm. so, again, somebody like Good Steward Lending Services in Arizona works with private lenders.
Yeah.
Who otherwise would be classified as a hard money lender.
Yeah, and that's another one that so to make that distinction between a hard money lender and a private money lender. Yeah, exactly.
Yeah. Can be a little different. So again, most hard money brokers, that's really a good term. They're in the business of marrying the two parties together, a borrower and a hard money lender together. And they may also be lenders, of course, but as a whole, they're in the business of marrying the two parties together.
Yeah. One of the ways that I sort of make the distinction is that a hard money broker brokers private money for an investor. So a private money lender may be going through a broker. And that's sort of, in my mind, at least, where the transition goes from a private money lender to a hard money broker.
Right.
So,
right.
yeah. So just, okay. So we have the broker services. We've talked about owner occupied, non-owner occupied. What are the steps? We talked a little bit about the background checks. What are the next steps in the paperwork as it comes in? So Johnny has brought in a deal to his uncle, and his uncle is ready to fund it because everything so far looks good. What's the next step for them when they want to get to the closing of this deal?
Right. So I started by talking about that from a broker perspective. So that would lead into the lender perspective. And so what we end up doing, and there are lots of services like ours, but what we end up doing is then taking that lender. So somebody comes to us as a lender and says, I already have found the deal. So unlike the broker where I'm taking it to a lender, the lender is coming to us and they're saying, I think I already have a good deal, but now I need the real lending services to take place. The broker services that had not already been done.
Yeah.
And they come to us to then complete the underwriting process and again, the background checks and all of that, and then over their shoulder and look and say, well, okay, you laid out this as the project. Let us kind of relook at that and evaluate it. Right? Now, in that case, we're not going to make the yes or no decision, but we're going to report back and say why we think it maybe we agree it's a good deal and why we might disagree that it's maybe not such a good deal or that there are other circumstances that they haven't considered, which frankly we run into a lot because the team's been doing this a long time and it's always easy to miss. So it's always better to work in collaboration. We have lots of clients that are well-seasoned, have been doing this a long time, and they'll bring us something and we'll look at it and then we'll talk about it and then come to a decision as to, sometimes maybe they miss something or whatever, right?
Absolutely.
That's kind of the nature of that collaborative relationship. Instead of making a decision all by yourself, the more eyes I can look at it, the easier it might be to find something that would be bad, right? Would be negative.
Yeah, and that's where the many years of experience of the team experience is such a great teacher, especially if some of the lessons didn't always go as planned. So no, that's great. When you're doing that process, do you have a certain checklist that you go by? I'm assuming.
No, I mean we do. We do have a form of a checklist depending on what type of transaction it is, and work off that checklist. That checklist includes some blanks too, right? Because sometimes we run into something that leads us to another area that we didn't necessarily have on our checklist, and that happens, regularly, so to speak. Because part of the checklist is looking for things not on the checklist, so to speak. Yeah,
right? Something that trigger that thought to go down that path, so that if there is something, we at least turn the rock over to see if there's anything under it.
Right, exactly. And sometimes there's not, right? Sometimes there's, it let us just look at something and then we looked at that and said, yeah, no, it's good. There's nothing wrong there.
Yeah.
So that definitely happens. But that's part of that lending services. And so while we complete the lending services portion, it's usually leading into the loan servicing. So while we vetted it, or we've helped the lender vet it, then we move into the servicing side where we're tracking that transaction and working through it. Now, admittedly, most of our clients on the lending services side are related on the account servicing side because they kind of go hand in hand. You often have, obviously, the lending pool, whatever sort it is coming in on one part so we can manage that back end. But they're also performing the loan. So it allows us to kind of help on both sides and give, obviously what we consider better advice, better experience, better understanding of the transaction, right?
Mm-hmm.
For the funds, we're the investment advisor also. And so we're pulling that information, able to take that and pull that into the analysis for the sake of the fund, right?
Mm-hmm.
It doesn't meet the criteria for the fund. And so it allows us to kind of do all of, not just to plan these areas, but to really bring it together more comprehensively.
Right. Okay, good. So now we've got it. We're at the closing table. Everything gets, well, this is an interesting thing. Just to digress here a little bit, I did a lot of my business in Minnesota, and it was always tabletop closings. I mean, very seldom were closings done separately. And here in California, it's odd if you even request such a thing, to be able to sit down at a table and have everybody sign documents at one time. So that was just something new to me. So depending on what state you're in, you may or may not all sit at the same table. You may or may not sign on the same day. But let's say that we've made it to that point. What happens to the money? Does the borrower get all the money and they can go run off to Tahiti or the active investor, whatever you want to call it, whether it's a joint venture or borrower-lender relationship?
So what we end up doing is holding those construction reserves, right? We don't just, lender doesn't just release all the funds to the borrower either, right? So generally speaking, there's a project, a plan, and that project plan, there's a budget for it, and there's an expectation of phases of how they're going to go through the construction. And so the lender would generally be managing or monitoring that progression. And sometimes they use a third-party builder's control company or a contractor or so forth. But what ends up happening is we're holding the reserves for that construction. And so as they progress through their project, they ask us for draws off of that. And then with certain approvals, we then release those draws to an appropriate party, a contractor, or whatever the situation calls for. Mm-hmm. That way, the borrower doesn't receive all the cash at once either. They have to complete the project. That's the plan, right?
Right.
At least that's the plan within reason. I mean, they have to do certain monitoring and make sure that it's going along like it's expected to.
Right, and that also would apply to if there's monthly payments built into if it's a loan, or I guess what I'm saying is interest reserves, interest reserve accounts, that type of thing. So there might be some of the loan proceeds that may go into an escrow account that is there specifically to be able to make a monthly payment to the investor, so that there's cash flow coming off of that loan or that investment that investor makes.
Right. Yeah, that's right. And not necessarily just interest reserves. So one scenario is construction reserves are set aside to complete the construction or certain phases of construction. Interest reserves are set aside to ensure that loan payments are made out of the reserves, which is nice for the borrower because it relieves him of having to deal with that. Mm-hmm. And then also other types of reserves. So sometimes there are cases where we just simply have what is commonly called default reserves, where we've told the borrower, you got to have a certain amount of money in reserves in case something goes bad. We've got a buffer to pay for legal expenses, foreclosure fees, that sort of thing. And then other stuff. So you got hazard insurance that might be impounded out of that, payments to other lenders. Sometimes there's reserves that pay other lenders.
Maybe real estate taxes.
Exactly. Right.
Yeah.
So other types of fees that might be paid, or other types of expenses also.
Okay. So then we've gone through the process. The project is pretty well complete. We've got all our lien waivers. We've got all the paperwork that's ready to close it, the final closeout. Then the private investor, Uncle Joe, calls up and says, or he wants his money back, basically, right? On the sale, let's say the property is then sold to a new buyer. How does that process work?
So there's two sides, right? We've got the account servicing side that's really managing that pool,
Mm-hmm.
those investors. And then we've got the other side that's just the lender. Now, a lender might be a single person, which of course has no pool to manage. So if it's a single person like Uncle Joe, then they might be only strictly in the loan as a lender.
Mm-hmm.
And in that case, when we provide a payoff demand to the borrower or the borrower's closing agent for the sale of the property, we're going to receive that into our accounts. We're going to then process it, including interest, any other fees, and so forth, and then disperse that out to the lender.
Yeah, and
that's
that
way to say it, out to the lender. Now, sometimes that lender is on the other side of the one of the other businesses too. It might actually
right.
be a fund or a pool of some sort. But
Yeah, and that's where your services come in again. The point I was making, aiming towards before, was the payoff demand is actually a document. It's the accounting of what is owed on that day, assuming the payoff happens on that day.
Right.
Yep.
Exactly.
And so then that would be what might come in as a payoff on that particular loan or that particular joint venture arrangement, whatever that might be. Mm-hmm. And then where you were going with this, I believe, was that now there may be other distributions that happen based on servicing that you may have provided to that group.
That's right. Yeah, yep. Exactly.
Yeah.
So,
okay.
And that's why they're very independent, because we certainly have clients that are lenders that are pools, mm-hmm. but we don't service their pool. They have their own accountants and their own back end. They're large enough that they have their own back end processes. And so the lending side, the servicing side, the loan servicing side will receive those payments, including payoffs, but even other individual monthly payments, mm-hmm. and process that out to that lender someplace else. Yeah. And their team then services their own back end, their mm-hmm. own pool. And then we have those where we service their back end and do their accounting. But it's really the exact same process. I mean, literally, we process a payment from one servicing side completely out to the lender, even if another division is the one handling that.
Yeah, yeah. Excellent. So that takes us pretty much through that full cycle. Thank you for that, for walking us through that. And I would like to ask you this, and I didn't ask you ahead of time, so I'm going to see what you say. Usually on these episodes, I like to see if there's anything that can be provided to the listeners. So is there any sort of a checklist or something that we might be able to provide for them, or that you might be able to provide for them, that where they may email you or they go to your website or something, just to help a little something to help them get to that next level? Can you think of anything? And I apologize, I should have asked you for this before our discussion here, but how do I know unless I ask, right?
That's right. That's right. Well, I'm working on a short white paper that will discuss the sort of how the economy, the four major things in the economy, come together to help lenders understand the future of the economy, and they can take that to understand why as a financial economist like myself, why we look at some of these particular major indicators to make decisions. Right.
Oh, that could be really valuable.
It's just a little bit informative, but I think we get lost in a lot of times today with, what is CPI, right? What is the Consumer Price Index, and who cares what employment rate is? How does that affect me as a lender in business? And, these types of indicators that we generally feel like, why does it matter to me?
Yeah.
And they're indicators that really can help their business to understand where a particular market's going, or a state, or the nation as a whole. And so it's actually it's interesting for me, because a lot of the conversations I have leave that sort of conversation out with, when I'm talking to a lender or to an investor, they leave that out. Or, and this happens almost all the time, is they think that it doesn't matter. They think that things like inflation, they have the argument about, well, the inflation doesn't, the government provided inflation doesn't include certain information, and so they don't understand well enough. And, we should be looking at, what is it? The website, I can't remember the name of it. There's a website, Hidden Stats, inflation stats.
Yeah. Yeah. Right.
And it's really a lack of understanding of why we care about those particular numbers. Once you understand why those numbers matter, then it can obviously help a business and have an impact on
yes.
his business.
Absolutely. No, that's great. And no, thank you.
Shadowstats.com, I think, is what it is, which is hugely good. It's important to understand inflation, but it's the reason why certain industries are left off that information that we use as an economist, from an economist's perspective. There are reasons for it.
Mm-hmm. Yeah,
so we should disregard those reasons, right?
Yeah, right. No, that's great, and thank you for that offer, or if we call it an offer after I asked for it. So, if people want to reach out to you, what's the best way for them to reach you, Rob?
Well, I mean, my email address is robert.barr@goodstewardservicing.com. So goodstewardservicing.com. That's a little bit of a mouthful, but robert.barr@goodstewardservicing.com. Our parent website is Good Steward FSG, which stands for Financial Services Group. So goodstewardfsg.com.
Okay, and we'll put those in the show notes so that if anyone is driving or doesn't have a pen and paper right now, just we'll have them in the show notes so that you can reach out to Rob that way. One last question, Rob. If you were to suggest a resource or a book or something that you thought was helpful for you or that you think would be helpful for listeners, anything come to mind on that?
Okay, well, there's nothing specific to the industry. Mm-hmm. Right. I'm going to say this with a grain of salt. Some people may not appreciate it, I suppose. But honestly, I'm an avid Bible reader.
Mm-hmm. Okay.
The reason why I say that, and I when people ask me, I kind of lean toward that, is there's a lot to be learned about, frankly, the economy, mm-hmm. how the world works, how it is that we consume goods and mm-hmm. sell goods and such. And more than I think people realize, because I think of it only from the sort of theological standpoint.
Yeah.
But again, I'm an analyst, right? So I tend to kind of think more than just on the surface. And honestly, I love it.
Yeah. Yeah. So I think, so for anybody who doesn't go down that path or doesn't necessarily agree with it totally, I think that and can't say I've read it a whole lot, but the bit that I have, it's a great storybook.
Yeah.
Right. I mean, it has a lot of really good stories. And so whether we have other faiths or this faith or whatever, I think that's a great, suggestion is
there's information to learn there, especially, even if you just stay in the Old Testament, which of course has the broadest faith-based reading. But of course, one would expect it by our name, right? Where again, our companies are Good Steward. And so we think of ourselves as stewards for, in this case, other people, mm-hmm. Their capital, their borrower relationships, and so forth. So I think it all kind of stems from that idea. So, quite frankly, that's probably my first go-to book, because it's this foundation of stewardship, mm-hmm. right? Taking care of things, taking care of people, taking care of the world, all these things that are involved. And that really, for me, is the foundational first, because without that, you're just another salesman. You're just another Joe business guy who's trying to make money, mm-hmm. and not necessarily providing something to the world or to the economy, right? Mm-hmm. Which really has to happen first. I mean, we all know the most successful entrepreneurs really provide something to the rest of the world. They're not there just to receive money for it. They're providing something, right?
Yep. Excellent. Great. Well, thank you, Rob. This has been a real pleasure. A lot of information here. We'll have show notes on it, and we are even going to, I would typically do a transcription of these podcasts as well. So if anybody wants to get a copy of the transcriptions, we can get that. If anybody has suggestions, ideas of what topics you would like us to cover, you give me somebody to go interview, and I'll do my best to see if I can bring that person on or those people on. Really, what the purpose of this whole podcast is to bring knowledge together, bring people together, bring everything together in a very collaborative way, from the abundance mindset, where if everybody works together, everybody is pulling in the same direction. Everything comes together much more efficiently, much smoother, a lot less weight on our shoulders. We know our backs are being covered. And in the end, the result of that ends up being a safer, more profitable project. And it makes life just a lot more fun when everything is going the way we like it to go. And so with that, we'll sign off here. But Rob, again, thank you very much. And we'll get your information in the show notes. And looking forward to another interview very, very soon.
Great. Thanks a lot, Tom.